Okay, welcome to the next lecture for ES300. Today we're going to do a recap of the last several lectures, actually, that sort of combines the beginning part of the course about the financial and economics bootcamp with the time we spent talking about the history of the electric power industry and going inside an electric utility. And this is meant to sort of synthesize what we've talked about so far. And sort of preview, and to some extent, what's going to be on the midterm. So last time we talked about retail rate setting, the different parts of utilities cost pyramid and different parts of an electricity bill. And then we talked about rate cases and how utilities work alongside utility commissions to determine what the fair price of electricity is for retail consumers. We also ended up with a discussion of how utilities and utility commissions deal with unexpected cost increases, both conventional cost increases like unexpectedly high demand or high fuel prices, as well as accidents, for example, forest fires or coal ash spills, and some of the philosophy behind whether or not utilities should be allowed to include those costs in retail prices for customers. So we spent on the order of 10 lectures so far talking about the sort of basic financial and economic aspects of the electric power industry, including basic project finance, so how a utility would get the money to build stuff, net present value analysis, so how utilities decide whether or not to build something once they get the money to do it, firm production decisions, so how utilities can optimally operate the things they build once construction is over, market prices, so how prices for the thing they produce, electricity, can go up and down. We've also talked about the history of the electric power industry. We talked about its early days and both important technological innovations and policy decisions that were made early on that set the stage for both the use of AC power systems and also the business framework and regulatory framework known as the monopoly consensus, which existed for on the order of 60 to 70 years and resulted in very low prices for electricity until it didn't. And that led to deregulation. And we talked about the two different types of systems that we have in the United States: deregulated markets and regulated markets. And then we spent the last three lectures going inside an electric utility to talk about long-term planning, so how system operators decide how much and what type of new generation capacity to build. We talked about short-term operations, so how utilities decide how to use the plants they have already built. And then we talked last time about retail rate setting, so how prices for retail customers are set. So we want to today tie some of this together in a admittedly somewhat haphazard way, but there's going to be a few applied examples with relevance to the take-home midterm as well. And this, I'm hoping, will bring up some of the old stuff, bring it back to the front of your mind, while also tying that together with some of the more recent topics we've talked about more recently. So far we've discussed issues related to how power systems accomplish a number of different things. For example, financing and building any necessary capacity additions, operating power plants in an optimal way, and also charging retail electricity customers a rate that is fair. So whose job is it to coordinate the planning and operation of power systems? Pretty broad question here. So there are two answers. In regulated states, it would be monopoly utilities. Example in North Carolina would be Duke Energy, alongside utility commissions. In deregulated states, we have independent system operators, or ISOs, and regional transmission organizations, or RTOs. They're really in charge of the long-term system planning and day-to-day operations of the grid, even though they don't own the physical assets. So why, again, do we have two different ways of doing this in the United States? Why do we have regulated and deregulated markets? Well, that goes back to the history of the electric power industry. Remember, in the 1970s, there was this upward pressure on electricity prices, partly because utility commissions had allowed electric utilities to build a lot more generating capacity, and it turned out that generating capacity was not needed. Demand didn't increase as much, and the customers blamed the regulators. So they viewed the system of having utility commissions oversee the capital investment choices that utilities were making as being particularly inefficient, that had led to increased prices. And so there was this pressure to deregulate, especially in states that were experiencing high retail electricity prices, and the result was You have some states in the United States that are deregulated, that have competitive markets for wholesale electricity, where power plants are competing against each other on the basis of cost in order to provide electricity. And then you have other states where you still have this vertically integrated system, where you have monopoly utilities that own the generation, the transmission, the distribution, and they use all of that in aggregate to provide electricity for customers. So what determines how much generation capacity a system actually needs? So we talked about this in the context of long-term planning. So the target that utilities or system operators would typically shoot for would be an ability to meet peak system demand. So that's the highest electricity demand experienced in any single hour, usually on a hot summer day at 4 p.m., for example, plus some extra. We need extra capacity built into the system in case something bad happens. We call this the reserve margin. So, for example, let's say a utility projects a peak system demand of 10,000 megawatts in 3 years. If the utility wants to maintain a 15% reserve margin, and it currently has 10,750 megawatts of generation capacity installed, how much new generation capacity does it need to build? Well, the target capacity would be peak system demand plus a 15% reserve margin. So if the peak system demand is 10,000, the reserve margin would be another 1,500. So the target capacity is 11,500. And if current capacity is 10,750, what we need is 750 megawatts of new capacity. So how do we forecast future peak demand? So one example would be to use a simple predictive model. And so we have this equation here, YT, where YT is equal to predicted peak electricity demand in year T. And we're estimating that as a function, as a linear combination of 4 different explanatory variables that are all weighted by these coefficients A, B, C, and D. So the 4 explanatory variables we're considering here are WT, so that's economic index in year T, some measure of economic productivity. The population in year T, XT. So as population increases, generally we assume that electricity demand or peak electricity demand increases. Per capita energy consumption, or ZT. This has an indirect relationship with peak electricity demand. So as per capita consumption increases, peak electricity demand increases as well. And then daily maximum temperature, because so much of peak electricity demand is driven by heating and cooling needs, especially in the Southeast. We're going to say mostly cooling needs. In the middle of the summer, the value of the hottest temperature on the hottest day of the year is an indicator of what peak electricity demand is going to be as well. And so we could use this predictive model, especially if we had all of this historical data. If we had a record of peak electricity demand, and alongside that we had contemporaneous or simultaneous records of the economic index, the population in millions of people, the per capita consumption metric. And what that would suggest is that a higher value of per capita consumption means less energy efficiency, and lower values would mean more energy efficiency, and then the maximum average daily temperature. So we could use values for the coefficients A, B, C, and D that appropriately weight economic index, population, per capita consumption, and maximum average daily temperature to most accurately predict what peak electricity demand is going to be. And so we want some sort of model that compares favorably our prediction of peak electricity demand with actual demand, with the understanding that there's going to be some error associated with our predictions, especially with such a simplified model as this. And so once we have identified the best fit values of A, B, C, and D, that allows us to plug in any 4 values of WT, XT, ZT, and VT and get a good estimate of YT, we can then substitute in forecast values of WT, XT, ZT, and VT in order to get a forecast value of YT. Now, a question here is, what if some of these explanatory variables, WT, XT, ZT, or VT, are uncertain but not really predictable? Like, we don't have a good forecast of what those values are going to be. So one thing that we could do is treat one of those explanatory variables as a random variable. For example, we could treat maximum daily temperature, VT, as a random variable with a normal distribution. And then we could take lots of samples. And so what that would suggest is that we'd have some sort of value for the average maximum temperature given a historical record. And that would be the mean of the distribution if we assume a normal curve. And that means that as we're taking samples, we're more likely to get values that are close to that average value. And we're less likely to get samples that are really, really far above that average temperature or really, really far below that average temperature. And so we could plug in those hundreds of samples. And then what we would get from our predictive model is a probabilistic estimate of peak system demand. And then it would be up to us as the utility commission and the utility to decide what our risk tolerance was. For example, if we had a resultant distribution of peak system demand out into the future, we could choose to build an amount of new capacity that would allow us to meet the average here. But what that would imply is that in 50% of all years, we would not have enough capacity to meet peak electricity demand. So we could go further to the right as part of this distribution and install an amount of capacity that would allow us to meet peak demand in 99 out of 100 years or 99.9 out of 100 years. And it would ultimately be up to the utility commission to understand what this risk is, the probability of peak system demand out into the future, and how that varies with uncertainty in some of these explanatory variables, and then make a decision about what level of risk is okay, and that would translate to a certain amount of capacity to build. So just some historical perspective here. So how fast do you think electricity demand is actually growing in the United States? Well, it turns out that it's not growing very fast at all. We've seen this precipitous decline in electricity demand growth on an average over the last 50 or 60 years. And you can see where we are now is somewhere around or maybe even below 1% growth in demand per year. And a lot of this has to do with increasing efficiency, as well as the loss in the United States, at least, of industries that are large energy users like manufacturing. So as we've moved away from a heavy manufacturing sector to more of a service economy and efficiency has increased, electricity demand growth in the United States has also declined considerably as well. So then the question is, why do utilities build new power plants? If demand is not growing, why are we still thinking about what new power plants to build? And the answer there is that most new capacity is actually being built to replace older power plants that are retiring. So what this figure shows, this is from the US EIA. It shows you the original operating year when the plants were built by type and by capacity in the United States. And you can see that we built a lot of new capacity in the 70s, a lot of coal-fired power plants, some nuclear power plants, some natural gas power plants. And then new construction of power plants really dwindled from the mid 1970s down to the early 2000s. And then as a lot of those plants that were built in the 60s and 70s and 80s came up for retirement, we started to build a lot more new generation in the early 2000s and throughout the last 20 years or so to replace a lot of those older power plants that are retiring. So who actually builds and operates the power plants? In regulated states, it would be monopoly utilities like Duke Energy. In deregulated states, it would be generation companies. So if we look at this map of the system extent of PJM interconnection, we see all these different colors. And all those different colors represent what used to be monopoly utilities. And so each one of those colors is associated with a company that has two different parts. One part of the company is a buyer of electricity, a retail distribution company who would be buying electricity from the wholesale market and delivering it to retail customers. And then there's another part of that same company that would be a generation company. And so they would own and operate all the power plants that used to be owned by the monopoly utilities. And those power plants would be selling electricity into the wholesale market, but also having to compete against power plants that are owned by all the other utilities on the basis of cost in order to provide electricity. So this is just what I mentioned. So utilities in deregulated markets are vertically disintegrated. So that's part of what's required to be to participate in a deregulated market. Utilities that were formerly vertically integrated as monopolies have to break up. And so they become three different wings of the same company. So a retail distribution company, a utility generation part of the business, and transmission. So how do utilities and generation companies choose what kind of new power plant to build? One of the most important criteria is cost, of course. So we can look at a comparison of the full operational costs, which means combining the fixed costs, so the annualized capital costs, in other words, how much it costs to build and finance the infrastructure, plus the variable costs, which would be the average cost of operating the power plant, so paying for the fuel associated with generating electricity, if applicable, across different technologies. And so what this is showing is the levelized cost of electricity. In other words, the amount that each different type of generation would have to charge customers in order to, by the end of its lifetime, to have made its money back, or to completely have paid for itself and broken even. And I've circled here 3 different technologies: advanced combined cycle, which would be natural gas, solar photovoltaic, and onshore wind. And these are among the cheapest types of generation that's available today. If we wanted to look at a more nuanced metric for deciding what type of power plant to build, we might look at net present value, especially if we're talking about a generation company that's participating in a competitive market for electricity, because they don't necessarily want to just look at costs. They also want to look at their ability to make profits. And they could discount those profits out into the future based on some sort of expectation. And compare different types of power plants alongside one another, while choosing the one with the highest net present value as the most optimal choice. So the way this would work, of course, is we would start with some sort of discounted cash flow analysis where we'd project revenues every year as well as costs every year, using revenues and costs to calculate profits. And then we would discount profits for every year and then sum them up to get the net present value. So recently in the United States, most new capacity has been natural gas or renewables. So the figure on the left shows utility scale capacity additions over the last about 20 years. And you can see that, roughly half, maybe a little less than half, but in some years more than half of new capacity additions have been from renewable energy. In 2018, you can look specifically at capacity additions throughout that calendar year. And you can see that most of the generation capacity that was added was natural gas. Pretty much anything that was not natural gas was wind and solar. And so this is consistent with what we see in North Carolina. Duke Energy has been retiring coal-fired power plants and replacing them with a combination of natural gas and renewables. This figure is from Duke Energy's integrated resource plan. So it's a plan of what they anticipate adding over the next 15 years. And you can see that it's a mixture of natural gas and renewables, with most of the capacity planned being dominated by natural gas. So that raises an interesting question, which is why not all renewables? Well, the fact is that not all that renewables are intermittent and variable, and so they're not always useful in meeting peak electricity demand. So in many systems, you need to have dispatchable resources, so power plants that you can push a button and turn on, and also ramp up and down in order to follow demand. And so the strategy that's been taken by most utilities throughout the United States is to invest in a combination of renewables and natural gas. The idea being that the natural gas, being more flexible and dispatchable, can complement some of the intermittent and variable nature of renewables. So as a result of these changes over the last 20 years, we've seen a change in the market share of different types of generation resources, right? So each one of these color lines tracks a different generation technology. And what we're tracking on the y-axis is the annual share of total U.S. electricity generation, so in a percentage. And you can see that over most of the last 70 years, the really dominant source of electricity generation in the U.S. has been coal, and that has changed. In the last 10 or 15 years, the share of electricity generation that's come from coal has declined rapidly, and what's been replacing that is natural gas. So you see this orange line increasing, and non-hydropower renewables, so wind and solar, which is the green line, also increasing rapidly. So a combination of things has led to, over the last 15 years or so, a 28% decrease on average in emissions, carbon emissions from the electric power sector. And now what this figure shows is what the expectation in 2005 was of growth in emissions over this same time period from 2005 to 2017. And in 2005, it was expected that electricity demand was going to continue to increase. And because electricity demand has not, and for a variety of reasons, remember, because of loss of industrial loads of electricity, so the manufacturing sector, as well as increasing efficiency, emissions are considerably less than what we thought they were going to be in 2017. And so that lower than expected demand growth has been the biggest driver in terms of reducing emissions below what we thought they were going to be. Alongside that, we have been switching away from coal towards natural gas, and coal emits about twice as much carbon emissions per megawatt hour as natural gas plants. So that coal to natural gas switch has also reduced emissions. And then adding non-carbon sources, so variable renewable energy like wind and solar, has reduced emissions even further. Now, the goal, of course, is to get these emissions down to zero. We've largely made headway here by just not using as much electricity as was forecast, and then retiring coal-fired power plants and switching them to natural gas and renewables. But the challenge for us in meeting any sort of climate objectives is to reduce emissions from the electric power sector to zero. Because remember, the electric power sector is only one piece of the total greenhouse gas emissions pie. And so we have a tremendous amount more work to do in terms of both reducing the electric power sector emissions down to zero, and arguably more hard work than what it's taken up to now. And then we also have to continue to reduce emissions from these other sectors. We're gonna continue to focus on the electric power sector in the rest of this class. So where does the money to build new power plants come from? So we looked at this early on in the class. There are two main sources: debt and equity. Remember, there's a trade-off in our use of debt versus equity. Debt is when utilities sell bonds, they're borrowing money, and there's a contractual obligation to pay this money back. But the reason why utilities rely more on debt is because there's a lower interest rate associated with debt. And part of that lower interest rate comes with the obligation to pay it back. So it's a safer investment for investors. The other source of capital would be equity, so essentially borrowing money from shareholders. There's no firm obligation to pay this back, but usually the rate of return associated with equity investment is higher. So let's look at an example plant. Let's say this power plant has a capital cost of $750 million, and we're going to finance it 2/3 of the capital costs with debt at a rate of 5%, and 1/3 of the capital costs with equity at a rate of 11%. So we can plug at least for the debt portion of this, we can plug the debt portion of the financing into an amortization calculator. So we're going to borrow $500 million at a rate of 5% with a lifetime term of 25 years. And what we would get out of that is some sort of regular annual payment that the utility would be responsible for making. This mortgage payment that would consist of two parts: principal and interest. And we've seen this time and time again, right? So if we borrow $500 million at a rate of 5% over 25 years, the annual payment turns out to be about $33 million. And we pay that every single year. And gradually we pay that debt off, which is what that declining green line shows. And the blue and red lines show the share of that annual payment that's made up of principal and interest. And at some point during the lifetime of this loan, they sort of cross paths, and more of the annual payment becomes made up of the payback of principal. So where do we account for mortgage payments? In a discounted cash flow analysis. These are costs. They're fixed costs. The utility has no choice but to pay the mortgage back every year. So these are costs that the utility would incur that do not change with the amount of electricity that's produced. So who decides how to operate power plants once they're built? Well, in regulated states, it would be monopoly utilities, and in deregulated states, it would be independent system operators. And what is that process called? Remember, it is the unit commitment and economic dispatch. So it's an optimization. And the objective of the optimization is to minimize the cost of meeting electricity demand. Demand is fluctuating all the time, and we have to fill in the area under that electricity demand with megawatt hours that come from our portfolio of different generating resources. And there's lots of constraints or rules that we have to follow when scheduling power plants to meet demand. We have to, number one, meet electricity demand. That's the most important constraint. We have to adhere to transmission line limits. So transmission lines can be congested and have a limited amount of electricity that they can send. So we can't send too much electricity along one line. And then there are also a number of specific constraints on the operation of individual power plants. Some power plants can't turn on and off as quickly. Some power plants, when we turn them on, we have to leave them on for a long time at a steady capacity. And other plants are more flexible. They can be turned on and off quickly and ramped up and down more easily. So system operators incorporate all of this information into a mathematical optimization. And the goal is to find the least cost schedule for every single power plant at each location in the network. And so we take this portfolio of generating resources that we have. So, for example, 32% natural gas capacity, 30% coal, 20 nuclear, 7% hydro, and 8% wind and solar. And each one of these is associated with different operational costs. And so the optimization algorithm would factor into the least cost schedule, how much it costs to produce electricity at each one of these sources. So if we're trying to minimize costs, we would probably want to avoid the more expensive sources of generation and rely first on the cheapest ones. But then we also have to pay attention to plant flexibility, right? So we can't use nuclear power plants to turn on and off quickly and ramp up and down quickly because they're physically not able to do that. And so what we end up with is a schedule in most systems that looks kind of like this. And obviously it depends on the specific mix of resources that a utility or a system operator has at its disposal. But we're going to use nuclear as base load in general, coal as base load, and a mixture of sort of shoulder, meaning shoulder demand period, so it can ramp up and down a little bit to meet fluctuations in demand, but we can't use it to meet those peak periods. Wind and solar we use whenever it's available. And then natural gas and hydropower we use as peaking resources. So in competitive wholesale electricity markets, how is the price determined using the least cost schedule? So we talked a lot about the microeconomic theory of how wholesale electricity prices are determined. But if we're using the combination of economic characteristics and engineering constraints at power plants, along with all the other constraints that might be on the transmission of electricity throughout the network, and we come up with this least cost schedule, we can estimate the wholesale prices as the dollar per megawatt hour cost of electricity at the most expensive plant required to meet demand in every hour. So, for example, if this is our system supply curve in a given hour, we have ordered pairs of variable costs, and we've organized the power plant capacity in order of increasing variable costs. So we start with the cheapest stuff and we end with the most expensive stuff. And then the last column shows cumulative capacity at each stage of the merit order of the cost curve. And so if electricity demand is 16,000 megawatt hours in 1 hour, we go down and find the most expensive plant that would be required to meet that demand. And notice that the cumulative capacity here is more than the actual demand, the electricity we require, 17,900. But if we just rely on all the plants before it, we only get to 15,300. So we have to exhaust the first two natural gas plants, the CC plants, and then turn on the one that's circled here in red and only use 700 of its 2,600 megawatts of capacity. But as a result, the variable cost associated with this most expensive plant, which is $60 per megawatt hour, then becomes the market price. So using market prices, how could we estimate how much electricity a given plant will sell? So this again goes back to some of the microeconomic theory that we talked about when we talked about optimal firm decision making. And remember, the rule of thumb has to do with the relationship between the marginal cost of producing electricity for a power plant and the price. Anytime where you see the marginal cost of a plant's production of electricity is lower than the price, that means that the plant should produce at a maximum capacity because it will be making a profit. If you see that the marginal cost is equal to the price, that means that the plant should probably still be producing at maximum capacity, but it basically will break even because it will be setting the market clearing price. And then if the marginal cost is greater than the price, then the plant will produce nothing. So if we look at an example plant, the same one, with a capital cost of $750 million, a generating capacity of 700 megawatts, let's assume that the marginal cost of producing electricity here is $20 per megawatt hour. We could go through with that system supply curve and identify every hour for an example day in which the price is greater than or equal to the marginal cost of producing electricity at this plant, which was $20. So I've highlighted every hour in which the price is greater than or equal to the marginal cost of producing electricity. And we're going to assume that in those hours, the plant is on producing maximum capacity or 700 megawatts. The hours where the price is lower than the marginal cost of electricity, we're going to assume the plant is off and not producing anything. So what does electricity production influence within a discounted cash flow analysis? So if we had an idea of how much electricity a plant was going to produce during the year, we could use that information to inform both revenues, because the revenues from the plant would be calculated as a function of how much electricity it sells, as well as costs, in this case, variable costs. So the more electricity a plant would produce, especially a coal plant, a natural gas plant, the higher its variable costs are going to be. So what if we want to compare the net present value of two different power plants under uncertainty? So let's say we do a net present value analysis of a coal plant and a natural gas plant, but we also acknowledge the fact that there might be different future states of the world, different market and policy scenarios that could influence the net present value for each plant. So let's say we have 4 different scenarios. One might be a high natural gas scenario, one might be a carbon tax scenario, one might be a low demand scenario. Things that could influence market prices or costs for individual power plants. And let's say we've calculated the net present value for 2 plants under 4 different scenarios. How would we choose which plant to go with? Considering the fact that we have these 4 different scenarios that have different probabilities of happening. What we would want to do is come up with some sort of expected value of net present value. So for plant 1, for example, there's a 35% probability that the net present value is going to be $100 million. There's a 25% probability that the net present value is going to be $125 million. There's a 10% probability that's going to be $40 million. And there's a 30% probability that's going to be $75 million. So the way I would calculate the net present value of plant 1 under these different uncertain situations is I would say $100 million times 0.35 plus $125 million times 0.25 plus $40 million times 0.10 plus $75 million times 0.30. And I would add all of that up to get an expected net present value for plant 1. And I could do the same thing for plant 2. And at the end, I would see which one had the highest net present value and go with that one. So what's the difference between a wholesale electricity market and a retail electricity market, and who participates in each? Well, a wholesale electricity market is where you have power plants that could be owned by different utilities or independent power producers that are all competing with each other to sell electricity. And demand in wholesale electricity markets comes from retail distribution companies. And so in wholesale electricity markets, the price goes up and down all the time because electricity demand is going up and down all the time. So prices in wholesale markets are driven by market forces. A retail electricity market is the exchange of electricity and money between a retail distribution company and retail customers. And so retail customers pay a different price, a retail price, to retail distribution companies. And that retail price has to be set in coordination with utility commissions. So how are retail electricity prices set exactly? So the process, again, is called a rate case. Rate cases are forward-looking. Utilities estimate what the future cost of service is going to be in the near future. What are they supposed to cover? Well, they're supposed to cover the cost pyramid for utilities. Most of utilities' costs are fixed, and a big chunk of that are the mortgage payments that are associated with all the debt they acquired to build all this infrastructure. On top of that, there are variable costs. Most of the variable costs for utilities come from fuel costs. And then there's shareholder profit. So retail electricity prices are supposed to cover all 3 of these categories. So here's a typical rate-making formula that a utility commission would use to help set electricity prices. And the way we start with this is try to figure out how much revenues a utility needs. And then we go from the target amount of revenues and we back out an estimate of the retail price that they would sell at. And this formula in general says R is equal to C plus V times R, where R is the target revenues that a utility needs to cover 2 things. C, a utility's total cost of service, which is both its fixed and variable costs. So fixed O&M, the cost of keeping the lights on, paying people's salaries, and also mortgage payments on all their infrastructure, plus variable costs, which would be either the cost of buying electricity in a wholesale market or producing the electricity in power plants that the utility owns and then selling it to retail customers. And then the other part of this formula is V times R, and V is the depreciated value of utilities infrastructure. R is the rate of return for utility shareholders. So technically, utilities are only allowed to make profits on the value of their utilities, the utilities infrastructure. So the initial investment that shareholders made, the equity stake that they have in all that infrastructure. So how much revenue does a utility need if, for example, their annual fixed costs are $50 million, annual variable costs are 35, infrastructure is worth $250 million, and the rate of return is 7%? Well, C here is fixed plus variable costs. So we have 50 plus 35 million equals 85 million. V, the value of the infrastructure is 250 million, and the rate of return for shareholders is 7%. So we can say R is equal to C plus V times R is equal to 85 million plus 250 million times 0.07, and we get a target revenue amount of 102,500,000. So what kind of charges are in an electricity bill? So there's two parts in general. There's fixed charges, which are fees that every customer would pay no matter how much electricity that they consume. And these are what would help a utility recover utility fixed costs of serving a customer, including meter reading, billing, and administration costs. The other part of an electricity bill is the volumetric charges. So these do accrue proportionally to how much electricity a customer uses. So the more electricity you use, the higher your volumetric charge is going to be. And these are typically charged in some sort of dollar per kilowatt hour rate. So what should the volumetric charge be if the utility has 1 million customers and charges them $40 each just to be connected, and demand for electricity is 1 billion kilowatt hours? So we can assume that the utility is going to collect $40 million through the customer charges, the charge that they put on electricity bills over the course of the year. So every customer, just for the privilege of being connected to the grid, has to pay $40 per year, and we have 1 million customers. So that generates $40 million worth of revenue for the utility. So we can subtract that from their target revenues, 102,500,000, and that leaves us with an obligation of trying to meet $62,500,000 through the volumetric sale of electricity. And so we can divide that target revenue amount, 62,500,000, by 1 billion kilowatt hours. That's what we think electricity demand is going to be. And we get a volumetric rate of 6.25 cents per kilowatt hour. So what happens to return on equity for shareholders if demand permanently drops? So customers are putting on rooftop solar, adopting rooftop solar, and the price is not changed to reflect that. So let's look at that situation. So we're assuming a permanent loss of demand of 5%. So the one thing that a loss of demand would influence are variable cost. So if we say that the utility has lost 5% of its demand, and then we can say it's also lost 5% of its variable costs. So variable costs drop from $35 million to $33.25 million. And then we also have to, as a part of this, recalculate the target revenues, because their variable costs are lower. That means they have to collect less revenue to cover all their costs and make profits for shareholders. So the value of C would change here. It's now 50 plus $33.25 million. And the value of V and R stay the same, or little r stay the same. And so big R changes from 102,500,000 to 100,750,000. So that's our new target revenue. And we can look at how this new target revenue compares to the actual revenues that we make selling electricity. And in this case, demand for electricity, the amount of electricity we actually sell, drops by 5% as well. So it goes down from 1 billion kilowatt hours to 950 million kilowatt hours. And so as a result, we earn less money because the price of electricity has not changed. We set the price of electricity based on our original target revenues. And we can also calculate the change in the rate of return for shareholders using the same equation, R equals C plus V times R. So the actual revenues that we earn are 99,375,000. And so this is considerably less than the target of 100,750,000. And so we can also calculate the corresponding change in the rate of return for shareholders. So we can plug in our actual revenues, our costs under 5% reduction in demand, as well as the value of depreciated assets, and solve for R, and we get 6.45%. And so what could the utility legally do to increase its return for shareholders back to 7%? And that is increase prices on customers. When did this sort of happen in the past? So if you recall our conversation of the 1970s, in particular, when utilities built too much nuclear power capacity, expecting continued exponential growth in electricity demand, when that did not happen, lower demand caused financial shortfalls for electric utilities. They had to raise prices in order to maintain the targeted return on equity for shareholders. Okay, that's it for this recap. Reading 7 has been assigned for next time, and the midterm has been assigned as well. Next time, we're going to talk about the coal industry.